The only question that doesn't get answered is the one that is never asked. So please feel free to comment your questions below or reach out to us directly. Thank you. Hello and welcome to the Durham Talents channel. My name is Jesse Durham, back for another installment of our question and answer series where we are going to address your questions concerning the infinite banking concept as conceived and described by R. Nelson Nash in his book, Becoming Your Own Banker. Let's get started. Question number 1, and this is going to be from Astroman. That's a catchy name, isn't it? Astroman. What happens to the cash value when I die? That is a very important question. That is a question that is common, I think, partly because opponents of whole life, infinite banking, Nelson Nash, want to propose that the whole life insurance companies keep your cash value and only pay you the death benefit. And that's just a misunderstanding. So we don't mind addressing that for sure, because we believe that the more you know, the better choices you can make. Nash actually would say that when you know what's going on, you'll know what to do. So let's address this question of, does the insurance company keep my cash value, or what happens to my cash value? Now, specifically here, we talk about properly structured, properly meaning for the banking purpose. So properly structured whole life policies with insurance companies that pay dividends, participating mutual life insurance companies. Now, with whole life insurance, there is always a net present day value of that future guaranteed death benefit, and that is the cash value. So every whole life insurance company has a guaranteed cash value in the future. For your whole life, you can own that policy while you're paying premiums, and that's your only obligation, is to pay premiums to keep that policy in force. And all the other responsibilities are on the insurance company to perform, mainly provide that guaranteed death benefit. And every day from the time that that policy becomes an in-force policy, a unilateral contract, from that day until your day of mortality, your day of passing, your day of death, that policy value is going to increase until it equals that future death benefit. So therefore, every day between now and then, there's a cash value. So that cash value is just a representation today, net representation of that future death benefit. So it's not like simultaneously you have a cash value and, meaning on top of, a future death benefit. When you have a whole life insurance policy, you're guaranteed a future death benefit. The cash value just represents today net what that value happens to be. And you can use that, you can leverage that, of course, for the banking purpose. We address that extensively, but just in speaking about how whole life insurance works, that's what happens to your cash value. At the time of your passing, whoever you elect as your beneficiary is going to receive that death benefit tax-free. End of story. And in the meantime, there is a cash value to that policy, which is a net representation of that future death benefit, and that is the capital that we can use to implement the infinite banking concept. So I hope that's helpful, Astroman.
Yeah, next question is, how much would it be to fund for my grandson? This was a question. Susan or somebody asked this one. I can't read my own handwriting. I believe that's Susan. No disparagement, Susan. This is just having fun.
That's a great question to ask. How much would it be to fund for grandchildren? So I love that thinking. Nash speaks clearly about intergenerational planning and acting in his book, Becoming Your Own Banker. And of course, in implementing yourself, the infinite banking concept, you certainly get to the point where you want to be practicing family banking, meaning extended family banking and you're going to want to build a system of policies to account for your entire need of finance. So ultimately, for us parents and grandparents out there and so on, you get to thinking about assisting that next generation. Of course, continuing to build your own system. You begin thinking about legacy, scale, so many different and appropriate things. Now, specifically to the question of funding a child's policy, child or grandchild, it's important to note that before a minor child is insured, parents must be insured. So parents have to be insured before children or grandchildren, or if a grandparent is wanting to fund the policy for a grandchild, parents still need to be in possession of adequate protection. Now, that could be any kind of insurance. It could be term insurance through work. It could be a properly structured banking whole life policy, of course, with a mutual company. It could be that, but they have to have in force protection for children or grandchildren to be covered. Now, most everywhere within a matter of weeks, a very short amount of time, children can have policies taken out on them. And again, going back to the particular point, though, of fund, there's a lot that could be said here from my long-range thinking folks, but specifically, again, about funding. So parents have to be covered first. And not only that, but there are many companies, and there are some exceptions, but there are many companies that are going to insure children up to 50% of whatever the greater coverage is on either of the parents. So whether mom or dad have a higher coverage than another between those two, whichever parent has the highest coverage, we can get up to 50% in death benefit on that other child. Now, again, what amount of premium that ends up being, there's no way to say that. You're going to be in a position of finding what amount of premium is appropriate for every case-by-case situation. But there are going to be these parameters, though, of, well, you can only get 50% of the death benefit. So again, that's why it matters in talking with someone who is competent in structuring a policy appropriately for the banking purpose, taking many things into account. But I hope that this is helpful in giving a snapshot answer on how to go about funding for a grandchild. Get the parents protected first. And of course, naturally say, start with yourself. You always start with yourself because, again, if the idea is to provide tax-free income in the future to heirs, to beneficiaries, you should start with yourself. We are the older generation, the more mature generation, so we should be starting with ourselves for so many reasons, that being one of them for those that are thinking long range like that. And then we scale out our system from there, of course, but we need to get parents protected, parents covered. And there are plenty of folks, let me say this here, there are plenty of folks, and Nash in his book says, we're not focusing on the death benefit. It's more important to focus on the cash value. That is what it is. But there's also a relationship between cash value and death benefit. You can't separate those two from each other. They have a symbiotic relationship. And not only that, but again, I love how James Nethery says that when you wrap your mind around that, the cash value of the policy must eventually equal whatever the death benefit is. How big of a number do we want that to be? Do we want that to be big or small? So, assuming that we want it to be as big as it can be, with children, we're going to be limited up to 50% of the coverage, the protection, the death benefit of the parents. But again, the structure of the policy, it matters. So we're going to get the parents protected. We're going to structure a policy with considering several factors. And of course, you deciding on an appropriate amount of premium for that situation. So I hope that was helpful, Susan. Thank you very much for the question.
Next question says, could I start to pay off debt after 3 years or so? I'm currently not excited about my 401k and the $40,000 or so that I lost in the market recently. This is from Seth.
Seth, that's a great question. I appreciate it. Could you start paying off debt after 3 years or so? And meaning after paying premiums for 3 years, capitalizing your policy. Sure, if you decide to capitalize for 3 years and then start on what you have in mind, in this instance, debt recapture, absolutely, do it that way. Do you have to wait 3 years? No. Do you have to wait 3 months? No. We say you can start immediately, and our definition of immediately is within 30 days. Within 30 days of paying a premium, of a policy going in force, you can begin to access capital to accomplish whatever the given task is that you, in the private banking position that you are then assuming, whatever it is that you're choosing. In this instance, it's debt recapture. So could you be, and again, if you're deciding, I'm going to capitalize for 3 years, I don't think that's the most efficient way. But again, if you wanted to, do it. If you wanted to wait 3 months and do something quarterly to recapture debt, do it. If you want to start right away, like my wife and I, when we funded our very first policy back in 2016, we paid our first premium, and in the next month, we were recapturing outstanding debt ourselves. So can you do that? Absolutely. The point is that you're in control. You're the one that's owning, capitalizing, managing, controlling this entire process. And that is a beautiful thing. Now, side note, I made mention here about the roughly 40,000 that was lost in the market. That's its own subject. But I understand why someone could be losing tens of thousands of dollars and just become open-minded to other financial information. And thankfully that's led us to have a conversation. I enjoyed our conversation that we had. Of course, you're in our process right now specifically to become a client. Look forward to working with you our next conversations and seeing you recapture debt, not just pay off debt, especially 3 years from now, but get to that much sooner, get to that much more efficiently. Again, if you can have the same dollars accomplishing more than one task, not just paying off debt, but paying off debt and getting the money back by implementing this process of becoming your own banker, that's just such a beautiful thing. And not be exposed to market volatility. And again, everyone listening this isn't advice for investing or anything. You can be as subject to the volatility in the market as you want to be. More power to you. But I certainly understand the sentiment of not wanting to be exposed in all areas to market volatility. And when it comes down to the banking function, securing that, controlling that, having guarantees there, it's a beautiful thing. So congrats on what you are doing, sir. And I hope that everyone else has benefited from that same question and answer as well.
Here's the next question. Nahum wants to know, can he use money from a policy for a down payment on a real estate property? That's a good question.
The answer is yes. When you own a policy and you call the insurance company to make a policy loan, they simply ask you how much of what's available do you want them to send and where you want them to send it to. That's what they ask. They don't ask what it's for. There's not this approval process to see if for X, Y, or Z you just get to access that capital in a known interest environment because you're the owner of that policy. You're a part owner of that company. You're just utilizing your contractual right to access capital. That's it. So do plenty of folks use their system of banking policies for their real estate endeavors? Absolutely. We have some experience with that ourselves. Do you have to start there? I'd also like to address maybe the opposing view here because I don't want anyone to be daunted by a real estate question like this, which is so good. It's so good. And the real estate folks tend to understand this concept of banking maybe quicker than some folks, just because of concepts like leverage, compound growth, banking. So it's really neat. But where does the average American start in becoming their own banker? With their household. With a lot of the shuns, the vacations, medications, educations, just the things that we're already doing anyway, vehicles, mortgages, those types of things. So yes, absolutely, you could use capital from your banking system for putting down a down payment on a property that you're wanting to procure, a deal that you're wanting to line up. Absolutely, you can do that. Great question, and Nahum, I really appreciate it. Here's our next question. Is from a unique phone call that I had recently with a prospective client. She asks, my credit union offers life insurance. Do I get it there? That's a great question. I have credit unions and commercial banks where I'm at as well. This is obviously a question from somebody who's not yet read the book, just recently exposed to the idea of becoming your own banker and just at the very start of the process. So natural question. We've all heard about life insurance before. When I'm giving a live presentation about this infinite banking concept, I like to ask from the front of a room who's not heard of life insurance or who has heard of life insurance. And of course, everybody's going to say that they've heard of life insurance. That's nothing new. It's not a new product. Now, there are lots of types of product out there, different companies, so many different variables, but life insurance is not new. So this idea of all these names, all these, all these companies that have their mantras, their jingles, these tunes, these theme tunes that are stuck in our head, their mascots. They have mascots. We think, of the box store approach of, well, okay, and here even thinking, well, my commercial bank or my credit union has life insurance. Mine does too. Ultimately, here's what I'm saying. Here's the answer to this. There's no one out there that can help you appropriately in becoming your own banker if they're not practicing that and implementing that exact process themselves in their lives and business. It's really hard to, we have these sayings about, practice what you preach. Okay. So sure, just about anybody can sell you a product. And I'm a capitalist myself. I understand that wealth is goods and services. So it's a beautiful thing that there are so many different products out there in the world in all the different industries that there are. But specifically, to procure a properly structured whole life policy with a mutual company that pays dividends for the purpose of becoming your own banker, for building a privatized banking system, I suggest that you consider going to someone who's already done such a thing, implemented such a process themselves, and then can help speed up. Well, basically everybody should consider finding somebody that does everything that we do here. Someone that's practiced this concept, implemented it into their own personal lives, business if they have that, investing if they do that. Someone that can professionally, properly structure a policy for a banking purpose, not in a cookie cutter way, but in a case by case, person by person, situation by situation basis, according to the outline in R. Nelson Nash's book, Becoming Your Own Banker. So, can you get life insurance from a credit union or commercial bank or from an insurance box store? Absolutely. And I had before as well. I had the work insurances. I had some additional insurance products that I'd bought before ever having read Nelson's book, just because I wanted to have protection. I wanted to have coverage. I wanted to do all the appropriate conventional things, and I went about it in a very conventional way. But this concept of becoming your own banker and implementing this process, well, that should be done with somebody who's already doing that, someone who can help you do that, speed up your learning curve. Of course, I'm going to say that here we put our best practices out in podcast and video, YouTube format. I always encourage everyone to read the book, Becoming Your Own Banker by R. Nelson Nash. I mean, go to the source material, read the book from the guy, and let's have a conversation. If you're working with somebody that can't show you their policies, what they've been doing with their own privatized banking system, if they've not implemented IBC, then they can't help you with IBC. And that's what I think about that. So I appreciate that question. And I certainly look forward in our process to having our next conversation. So thank you very much for the question.
Yeah, Scott wants to know, can a policy be owned by a business or a trust? That is a good question and a common one, Scott. Let's talk about it.
So certainly it's a common question to be asked. Hey, can my business own a policy? Can I get a policy and put it in a trust? The answer is yes. In fact, there's such acronyms out there as BOLI and COLI. BOLI standing for bank-owned life insurance, because commercial banks are the largest purchasers of whole life, and there's a lot to be understood from that fact. COLI, company-owned life insurance. So yes, business entities can own policies. Nash, again, said that this concept is bringing back to the me and the you level. So I think it's great to start right where you as an individual are, because even you, no matter if you're a 500 plus employee operation, you have a household and you finance everything that you do. So it's a great place to start personally owning policies. And then if that scales over time to accommodate your business or to accommodate your practice or to accommodate your investing or any other entities, awesome. But you can also just start with personally owning these policies to build your privatized banking system. Now, for a trust, can a trust own, and again, this isn't advice, talk to all the other appropriate professionals, but what I told Scott, of course, is that yes and no. Yes, policies can go to a trust, and they also don't have to. Again, you could just privately own these appreciating assets of properly structured whole life policies with mutual companies that pay dividends. You could just privately own them. Now, that is a transferable asset also, which is a great characteristic of a whole life policy, and why it's, in my opinion, the ideal asset is because it is a transferable asset. I could own a policy, for example, that I could transfer to someone else. Transfer that ownership. So I hope that's a helpful answer about businesses and trusts owning policies, and I appreciate the question, Scott. How long before we can access capital from a policy for a leaky roof? So Eric wanted to know, I have 2 pensions. If I pass, well, this was just preface conversation. If I pass, my wife's only going to get a third. So if I begin to fund a policy, he asks, how long before I can access capital for, say, something like re-roofing our home? That's a great question, Eric. I really appreciate it. I appreciated the conversation that we have in addressing that personally. Now here for everyone else. I know that there are plenty of folks that have issues with knowing more, especially when you're introduced to this idea of becoming your own banker, being able to compound your money into the future for the rest of your life while still maintaining access and control regardless of age. And then also knowing that there's a tax-free access to capital, and then, of course, a tax-free windfall to your heirs or beneficiaries at your passing. That's just so contrary to of course, all the other entities that are out there in the financial world. So Eric was pointing out with his 2 pensions, and again, he got those from a long, successful career in a valuable, much appreciated, it's an underappreciated, but I'm saying it's much appreciated field, being in firefighting. And those 2 pensions would only pay a third, though, to his wife at the time of his passing. Now, don't get me started on that right there. It's preposterous. There you go. Yeah, really, who knows? I don't know whether I'll keep this or not, but the idea that you would pay a certain amount for the lifetime of somebody who was in that service, and yet if their spouse succeeds them by living longer, you would pay them a fraction. It's preposterous. I'm saying preposterous to use a kinder word. I'd like to think of a more acerbic one, but here we are. So, with that kind of trajectory in mind, maybe because there are plenty of folks that have qualified plans or pensions or other things going on, and they're learning about this idea of becoming your own banker, and they're learning more about policies, and they want to know how they work. So the answer to the question is how long before you can access capital for something like a roof. And that was obviously something that was, again, it's like we all come to this idea with life going on. Maybe we have qualified plans, maybe we don't. Maybe we have children, maybe we don't. Maybe we're in this career, or maybe we're in a different career, and maybe it is about time for the appliances to be swapped out, or a renovation, or a new roof, or whatever the case may be. So what we say is immediately. From the time that a policy is in force, immediately begin to access. Now, our definition of immediately is within 30 days. So from 30 days of a policy going in force, a premium being paid, you can access capital in your policy. How much? Of course, that depends on more than one thing, but the first is to consider your premiums. What amount of premium are you paying? What is appropriate? What's an appropriate amount of premium for you? I mean, if you're going to say, well, I want to have enough capital in my policy to be able to re-roof the house. Well, you have to be funding that policy sufficiently to accommodate that. And that's just part of what would need to be considered. And of course, a further conversation with a lot more detail would help us arrive at what's going to be able to facilitate the things that you want to do both now. Now, when my wife and I got our first policy, we used it that same year, and we used it within a month, just like I'm describing here. But also over the rest of your life. These are whole life policies. You're going to own them, and you can use them your whole life. Isn't that convenient? So, from the start, a policy needs to be properly structured to accommodate your short-term plans and your long-range goals as well. So we had a great conversation, Eric. I look forward to our next phone call, and I hope that that's been helpful for everyone else as well that has these other variables in their situation. They're learning and vetting and implementing this idea of becoming your own banker. And I hope that this has all been very helpful in me addressing specific questions. If you have a specific question that you would like addressed, feel free to put that in our comment section below, or you can reach out to me directly so that we can have a conversation about how to implement and what it would look like for you implementing the infinite banking concept into your household or your business or your investing. And you can do that by calling or texting 828-817-4223, or you can email durhamtalents@gmail.com. This has been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care. Beautiful American flag there. So this was a very good question. Hey, you guys, here's what I need to know. Oh, I'm supposed to be checking this. Hello. I meant to move that. Oh yeah, let's do that. That whole 5, 4, 3, 2, 1 deal that we do. Hello and welcome to the Durham Talents channel. Hello and welcome to the Durham Talents channel. It's a great day. Hello, and we need a tagline. Why do I do that a lot? Okay, here we go.
What in tarnation are you howling at, dog? Good grief. Dog just barking and howling, trying to record. That's preposterous.
I do not know if I can do this voice, nor what voice it may be, but we will give it a go.